Hello, everybody. Welcome back to the show. I appreciate you joining me today. Today's video is going to be a market update of the current State of the Union from the job perspective in Q1 2025. So we're going to look at the current layoffs, hiring numbers, and federal job numbers. We're also going to look at the global responses to Trump's Liberation Day tariffs that were announced last week. We're going to look at the global corporate investment kind of tracking commitments, and then we're going to look at the overall upcoming predictions. So before we dive into all those details, I want to give you a reminder. Every Friday down below, there's a link to sign up for a weekly live webinar where you have a Q&A to me for an hour to ask me anything about professional development, job searching, professional career progress, whatever it might be. Also, if maybe you need a little bit of a one-on-one deep dive session, but on a very small topic, hit me up on Connect, which is also linked below. And if you're looking for some one-on-one career coaching and guidance, then down below is a quiz to get started. Click that link, and at the end, you will book a free consultation, and we can get the ball rolling. All right, without further ado, let's dive in. So the current U.S. job market numbers, when you look at the headlines, all of the headlines are based around two different things in particular. One is the job market, job creations that were added, and the unemployment slightly going up. I want to ignore these headlines. I want to look at the data and actually look at where we are at State of the Union for 2025 and what the overall trend has been month over month for the overall State of the Union. So first, let's look at the job market numbers. So the headlines that you'll see in the positive is that 228,000 jobs were added in March, which is almost double the 140,000 perspective and is over the 12-month average of 158,000. So this is a good thing. It's actually about a 50% increase month over month from February to March, because February was about 150,000, and then January was about 142, 143,000, if I recall. So overall, here in 2025, we have 522,000 jobs created. But we have more layoffs than we do job creations between private sector and the government. So we are still at a deficit or a negative job creation overall for 2025. So between January, February, March, private sector and government layoffs, we're sitting at about 775,000 layoffs and job closures. So we're still at about a negative 150,000. So this potentially, if you stop here, creates a doom and gloom scenario, but it's really, really not. Reason being is because we need to look at where these layoffs came from. So about 495,000, so just under 500,000, are coming from the private sector. And about 275,000 are coming from the federal government across 2025. So this is not just looking at March. If you look at March, I think the number for the federal government is about low 200s. But when you look at the whole year, it's about 275,000. So that's how we get to that 775,000 number. So it's really the federal government layoffs that are putting us in a negative job creation standpoint. If you take out the federal government layoffs and just look at private sector is actually up about 30,000 jobs for creation throughout the year, which is a good thing. This means that the job creation that's happening is coming from the private sector, despite the layoffs that are happening. Even though they are 2/3 of the private sector is 2/3 of the layoffs that have happened thus far in 2025, they are also 100% of the job creation that's happened thus far. So, and on top of that, when we look at February compared to March, it was a 50% increase. So this also means that if this trend were to continue to where we're talking about a quote unquote surplus, let's say, of that 75,000 jobs a month in comparison, so again, doing that 50% increase, then we would be looking at by the end of May, end of June is when we had a break-even point for 2025, including the federal government layoffs, and then entering positive, like I said, somewhere around end of June, entering into July. So this is good news. This means to keep applying, keep seeking new skills, keep reskilling and upskilling yourself into the things that are in demand. Okay? Because the job creation is on the way up. Now, I might slightly counteract myself, but I don't really think I'm going to in the upcoming tariff discussion here. But I want you to know that when you look at the unemployment rate headline that you'll see, which is going from 4.1 to 4.2%, again, if you look at where that unemployment rate uptick is coming from, it's not the private sector. The private sector is net positive. It's the federal government layoffs that's making that increase. So if you are for the downsizing of government, then this to you is a short-term pain for the long-term positive because the private sector is winning in job creation overall. And this is something that I predicted, is that there's going to be increased competition temporarily. But if the if the private sector can continue to outpace its job creation versus its layoffs, then those federal government employees that have the skills that are in the market, and the current private sector employees that are also unemployed, those jobs will come available to you shortly. It might not be the exact job you held before. You might need to upskill or reskill. And we'll talk about that here in a second as to what industries are hiring, what types of roles are hiring, and what types of roles are being laid off. But like I said, I wanted to get past the headlines of the job creation, and technically it's a net negative and the unemployment rate is up, but technically it's really only because of the federal government layoffs. And then overall, the private sector is a net positive, even when you look at it across the year and month over month growth and pacing. So next thing to kind of look at here is what industries are in demand. So these jobs that are being created, they are mostly coming from three different sectors: healthcare, logistics, which I'm going to break down into some subcategories here real quick, of transportation and warehousing, and then manufacturing as well. These are the three sectors that are hiring. They are not just hiring their technical roles, or the people that are the boots on the ground fulfilling those things. They're also hiring the administrative type of roles as well. So things like your finance or technology and IT staff and these sorts of things. So it very much depends on what your skill set is. And like I said, you might need to upskill or reskill. But these are the three industries that are hiring, and they're hiring across all types of positions that their company needs. So if you are on the job search, target those industries for when you're looking for jobs. Again, we're talking healthcare, logistics, manufacturing. Those are your top three industries that are helping to mostly produce that net positive private sector job creation. Now, what roles and industries are doing the layoffs? So, industry wise, we're looking at the primary layoffs being tech, retail, consumer products, and automotive. Um, the automotive one, I think, is in response to the tariffs, which we will get to later. And tech is one. I think the rest of these are really being disrupted by AI more heavily and quickly than expected. So, if you all watch my 2025 prediction video, I said that I believe that software engineers and developers and data analysts were going to be two of the most and fastest growing positions here in 2025. I stand corrected. These are actually two of the top most laid off positions in 2025 thus far. So this was incredibly shocking to me. But I will be the first to admit when I was wrong. And I think that what's happening here, as someone who is in the tech sector and is seeing what's happening to these roles firsthand, it is disruption by AI. The other one that's a big major contributor is going to be administrative roles. So things like your HR, entry level finance, talent acquisition, administrative assistants, these sorts of roles are just being really displaced and replaced by AI. When you look at the advancements of what's happening from an AI perspective, not just things like in your big large language models that people have heard of, like Claude or ChatGPT, etc., but when you're also looking at the specific solutions for each of these things. So if you are looking at agentic solutions, or if you're looking at specific software development and data analysis tools and solutions, maybe like a Codium or a Codo on the software development side, these are becoming digital workforce type solutions from an AI perspective. So we are beginning to see that white collar displacement that I also did predict. I just did not think it would be in these roles. But when I am in this industry or in these types of roles firsthand, my IT is my background for the last 15 years. The tools are becoming incredibly advanced, and that's why these are being laid off. You have AI tools and integrations that are now on a finance side able to do your monthly reconciliation, trend what is happening from your monthly sales and transaction perspective, and tell you where to put the gas on harder or take away spending or how to reallocate resources, which is usually what data analysts or finance data people are doing. On the HR side and talent acquisition, you have AI agent solutions that are doing resume analysis, initial screening, and initial email exchange, and setting up the interviews with the hiring manager directly with first level interview filtering. On the software engineer side, like I said, you have tools that are able to analyze and write code with turning plain English of the features you need into some baseline code that you can then modify. So the amount of people you need to fulfill your software engineer and development products is needing to be lesser and lesser. And this is the point in AI, that it will augment staff to either be able to produce the same or more with the shrunken staff, or reallocate resources from, hey, you have this other passion or this other skill set. Here's where we're going to put you in this company, or whatever it might be. So I fully stand corrected on software engineers and developers and data analysts being two of the most in-demand roles of 2025, because thus far they are two of the most laid off roles. And administrative roles is the other one. Now, the one that I can't quite nail down the cause why it's another big contributor to being laid off are product managers and designers. I can't find out the cause for this one. I don't know if they're being as disrupted with AI as well, or if it's something else. So if you have any suggestions or data points or things like that, leave them in the comments below. I'd love to have a discussion, even if it's just theories as to why this is happening, because I can't quite connect the dots on why these positions are being displaced and laid off. So to sum all this up, if we want to talk about overall job market, specifically State of the Union, we are talking about a private sector net positive job creation in 2025 of about 30,000 jobs, with a 50% increase in job creation month over month from February to March. Overall for 2025, though, we are still net negative from a job creation standpoint, because we've had about 275,000 people laid off from the government side of the equation that are now in the workforce. Our most in-demand industries are going to be healthcare, logistics, and manufacturing. Our top layoffs industries are going to be tech, retail, consumer products, and automotive industries. And the most laid off positions are going to be software engineers and developers, data analysts and engineers, product managers and designers, and administrative roles. Okay, now I want to touch real quick on wage growth, because this is something that is nice. So we do have year over year wage increase that is outpacing inflation, which is good. So depending on where you find your source and what month you look at, thus far in 2025, our inflation rate is about 1.8 to 2%. And when we look at the overall year over year increase, we're at about a 3.8% wage increase. So it is a slow and steady wins the race, that wages are getting higher and are outpacing inflation. So hopefully this trend continues to where, inflation stays low, wages start to have their slow and steady wins the race, and we end up at an equilibrium here in the long run. So please don't expect, a 10, 15, 20% raise, to just automatically, put yourself in a comfortable spot and, sort of a pre-2019 lifestyle perspective. But know that it is happening. And again, patience is the name of the game. All of this data is to tell you that is, if you are in the job market, if you are seeking jobs, hopefully this can help you stay positive, see that things are trending in the upward direction, and being honest with yourself that you might need to upskill or reskill. If you are in those top laid off positions, you might need to figure out how to reallocate your time from the job search perspective into reskilling or upskilling in order to get into a career that is in more demand, or an industry that's in more demand. And so that leads kind of well into our Trump Liberation Day tariffs that were announced Wednesday, Thursday, I think it was Thursday maybe, of last week. So this was an interesting one. This was supposed to be the reciprocal tariffs, that it was just matching 1-to-1. There's some controversy around how those calculations came about. Are they truly reciprocal, or is there another formula behind the scenes? I don't really care about that. I want to talk about simply the sentiment and the effect of the job market that we can expect, and that what's going to happen. Because it's definitely been a mixed bag of responses. You have some countries who are retaliating, you have some countries who are negotiating, and you have some countries who have just said, you know what, like, I don't like this, but I'm not going to do anything about it. And so it's just been a very interesting scenario. And so, again, we want to focus on what the responses are and how this might affect the job market, and what you can expect as a job seeker. So let's make sure we're understanding what a tariff is at a very high level. So if another country puts a tariff on a U.S. good, what does that mean? It means that our goods are costing more in their country for their citizens and population. So if we are selling US made jeans in China, then those jeans are now going to have an increased cost. And the question is, does that affect the demand in that country for our products? If it doesn't affect our demand, then we have no real net negative impact, right? We actually have a net positive, because we are going to get some of that money back from that taxation for our goods. And we don't have to lay off people. We don't have job loss, because we don't have a demand loss. Now, on the flip side, what does it mean when we're putting tariffs on? So, us putting tariffs is, again, if there is Chinese made jeans that we are selling here in the US, then those are going to cost more for our citizens. So, what does that mean? That actually really shouldn't affect our job market at all, um, unless it shifts where demand is. Because if, for instance, now the Chinese made jeans are more expensive than US made jeans, then theoretically the demand is going to shift to US, which would actually mean more jobs. If the tariff increase still means Chinese jeans are cheaper, then we're probably still going to buy Chinese jeans and the demand hasn't shifted and it's a net neutral. Um, so, from a job market perspective, like tariffs really shouldn't affect it that much unless it's our broad demand that changes significantly. And this is very possible. It really, really depends. Now, what this also means is that there are, like I said, there are countries who are maybe not responding. That just means that we're waiting to see whether the demand on their side in their country changes for us. But countries that are coming to the table for negotiation, this is where we could have positives for our job market scenario. So, for instance, I'll use the extreme example that's been announced thus far, tentatively pending some finalization. You take a country like Vietnam, to where Vietnam has actually potentially done a soft agreement with the US to just remove tariffs, which means that US goods sold in Vietnam would have no additional tariff or taxation. And on the flip side, any goods that are made in Vietnam that are then sold in the US have no additional tariff or taxation. And so this would actually drive the cost of both US goods in Vietnam down and Vietnam goods in the US down, which means the consumer really just wins because they're now cheaper and potentially the demand goes up, which means that there's job creation in the US if the demand for US goods in Vietnam goes up. And on the flip side, there would be job creation in Vietnam because their demand of goods in the US goes up. Um, so there's a lot of different scenarios here. And so I wanted to kind of break down how each country or continent has kind of responded and what that could potentially mean. So we have the China scenario, which has effectively retaliated and has also restricted rare earth exports to the US. So this can be potentially pretty big. I think China is the biggest one that we really need to know how things are going to go. In terms of, I'm not sure the real demand for US goods in China. I think that's one of our biggest trade deficits where we don't have a huge significant demand over there, depending on your company, because a lot of the US based companies that are selling things to China, they are being made in China in order to avoid the tariffs that were already there on US goods. Now, the restriction of the rare earth exports, this is the bigger one because this could affect the semiconductor industry. This could affect energy. This could affect a lot of different industries in the US that if we are unable to source these rare earth materials in a cost effective manner, then this could lead to really a slowdown in a couple different sectors around, like I said, kind of technology, AI, semiconductor, these sorts of things. So that is going to be one that we just kind of have to, I think, remain to be seen. And us two being the big global superpowers, it's a chicken fight. That's really what it is. So I'm not sure I can speak much on that one. I would be just purely theoretically guessing. Now, the European Union is an interesting one because you have certain countries in the EU who have said, hey, we need to negotiate with you. We want to reduce the tariffs. We don't want to do this. We are very heavily dependent on the US economy because the US is essentially a consumption economy. That is how a lot of the world has built up their economies on our levels of consumption. So they don't want to do that. But then there's some countries in the EU, like France, and I think it's France, their PM Macron, who has said to pause all US investments. He's not mandating it. He's just kind of urging EU companies. He can't really demand private sector companies to say don't do it, but he's trying to get them not to see how it goes. So the EU is split. So I think that's a very interesting one. Now the UK, who a few years ago went through kind of their Brexit scenario, they are actually coming to the table for negotiation. And they are one of our biggest trade partners in a variety of ways. So you have kind of Europe split in a variety of ways that I think, again, will remain to be seen. But I think overall what's going to happen is when you look at a company like Mercedes, for instance, right? So because automotive is one of the big industries that's being hit right now. So Mercedes is probably going to ramp up because they already have a huge production here in the US. I believe it's down in Alabama, if I recall. And so when you look at their competitors around like Volkswagen or BMW or these other, German automotive competitors that are exporting to us, they have a huge head start. So they would be so smart to just put on the gas pedal in terms of their workforce and production and output here in the US in order to just really accelerate their market advantage and take advantage of the fact that the other automotive competitors in Europe need to build the manufacturing facilities, deal with the contracts, hire the labor force, and get things up and running. So they have a multiple year head start. Um, so it's just going to be interesting. And I think when companies see like that as an example, and they see that happen, that I think that's going to urge a lot of the EU to actually come to the negotiation table. And I think negotiations are what's going to result here. So this is one that I think it's going to be a lot of headlines back and forth. But I do think in the long run, they're going to respond either with coming to a deal of, hey, here's reasonable tariffs that we have, or it's just going to be something similar to Vietnam, where it's just like, let's just remove it, free trade, let's go. Now, Canada and Mexico both have announced that they're going to do some sort of countermeasure. We don't know what that's going to be, and that could be pretty huge because this is going to affect our lumber market, energy market. Mexico also does a lot of manufacturing for us. Automotive, again, is one of the big Canada ones that are going to be hit. The New England area actually is going to be pretty hit from an energy perspective as well, because a lot of the oil and energy up in the New England comes from Canada. So we just need to remain to be seen what happens there. On both those fronts, I think when you look at what happened earlier in the year, when Trump threatened these and needed them to get to the border, and they both did their lockdowns and contributed, I think we're going to end up at a pretty reciprocal agreement. I don't think any of these three North American countries are going to let themselves be harmed, but I think that, again, there's going to come to a negotiation where everybody wins. Japan is an interesting one, to where they are looking at doing some exemptions. Now, Japan is one of our largest debt holders, so they are one that we really need to kind of have a good agreement with. And when you also look at automotive, right? I mean, Toyota dominates in North America. Toyota also has a lot of North American production already, a lot of US based production already. So going back to like my Mercedes example, they would be very dumb to not put them on the gas pedal and get the market advantage and accelerate that even more for other countries that to avoid these tariffs. But Japan is one of our biggest technology partners. There's a lot of companies. I think SoftBank is based in Japan, and they announced a huge investment into the US in order to avoid these tariffs. And they did that before they went into place. So I think a lot of Japanese companies are either going to shift investment to the US, which is going to make the Japanese government be losing production and capabilities and overall revenue. And so I think that the private sector from Japan, them already coming over to the US, is going to drive a positive negotiation there. Australia just bailed out. They pulled Switzerland. They just said, we're not going to retaliate. We just don't like that you did this. And then you have the negotiation countries. So India, Vietnam, Thailand, and Southeast Asia in general. These are huge because when you look at what these companies or these countries are doing in relations to the job market. So this is going to be probably the bigger part of the job market discussion here and what to expect. So India and Southeast Asian countries in general are some of the biggest in the US for semiconductor technology, AI, and innovation, and where things are going. So I think that these two regions in particular coming to the table for negotiations, I think is huge. I think it's going to lead to significant growth in the semiconductor space, in the AI space, in the data space. So if you are not in the technology sector, which right now is on a dip, again, it's almost like the stock market, right? Or like any sort of investment strategy. You want to buy low, sell high. I think right now the tech sector is a buy low. I think if you were somebody who's looking at reskilling, upskilling, where do I go? Where do I invest my time, effort, energy, and money for my future career? I think tech is the way to go. I just think right now you're not going to be in a great spot because that's where the layoffs are coming from. But I think that if you do invest in the technology sector, invest in IT, learn how to leverage these AI tools, learn how to build a portfolio of technology products, learn various large language model languages like Python and things like that. I think you will be very, very, very happy in the long run. Considering that these are going to, I think, be the two major drivers from a trade perspective in technology advancement and competition. And if you get the US, India, and Southeast Asia in an alignment, I think together we also outpace China, our number one competitor in the technology space. Especially when you look at the Indian education system, and if you look at their engineering schools and what they are outputting, they are slowly kind of becoming, if not already, the number one engineering output country. And they are also the second most populated country on the planet. So having good trade negotiations with them is key in the tech sector. Now, Vietnam and Thailand, this is an interesting one. This is actually going to cause a growth in your clothing industry, right? So already you have Nike, Adidas, Patagonia, and North Face, who are huge producers in Vietnam. Thailand is another one that I know there's a lot of companies that leverage from a clothing perspective as well. I also believe that Vietnam, Thailand, and Southeast Asia are also some of the most spice producing industries as well. So when you look at the growth here, these are going to be your targeted industries, right? So it may not be retail like it was traditionally. It might be more online shopping, but these companies that are in clothing production, if we come to negotiable terms where we have a really good trade agreement or potentially just pure open free trade like Vietnam is proposing, where Vietnam is saying, look, we'll remove all tariffs on you. You remove all tariffs on us for reciprocity, shake hands, walk away. This could be huge, huge, huge for the clothing industry to set us up to where we actually become a big exporter of clothing, which could drive a huge global demand and production here, both in the US and amongst these nations. So these are kind of the two industries that I think between thus far the countries that have announced coming to the table for negotiations between India, Southeast Asia, Thailand, and Vietnam. I am really looking at tech sector, engineering, AI, semiconductor, and also clothing. And then, like I said, kind of the spice industry, if you will. I think companies that are in these realms, they're going to be set to explode once negotiations are met. So again, as I mentioned earlier, with sort of just the currently growing industries of healthcare, logistics, and manufacturing, I would really add the other industries that I mentioned: tech, semiconductor, AI, data center, and clothing to that list as well. But they're more of a little bit of a long term play. They need to go through negotiations and go from there. Um, Now, with that, let's pivot into either both pre-tariff and post-tariff announcement. Corporate investment in the US that has been committed. Now, please understand, I'm going to give you a variety of information here and what job creation is going to look like. But this is all a big question mark because anyone can commit to something and then just not fulfill it. So this all could be lip service. Please take all of this with an asterisk and understanding that all of these investments that companies have quote unquote committed to or countries have committed to, there is an asterisk there. It may or may not happen, and we will never know until it does. But just picking this up with overall numbers, right? So there's been roughly $3 trillion in private sector investment that have been agreed to or committed to being invested roughly over the next 4 or 5 years, and roughly about 1.6 trillion committed since 1.6 in addition committed kind of non-tariff related. So all in all, over the next 4 to 5 years, we're talking about a $4.6 trillion investment from a variety of companies in production here in the US. Now, is all of that job creation? No. But we very, very quickly and easily get to a few 100,000 jobs created over these next 4 or 5 years. And I know that doesn't seem like much, especially when you're talking about a month of March that had 228,000, but all of this ramps up, right? All of this stuff stacks. It's just like when you're investing or just like anything else in your life, right? You don't all of a sudden go from an entry level position to being a director or a VP or executive in your career, right? It takes time and years and slow little chipaways to make this all work. This is not to discount the pain that people are feeling in the current job market and their economic state. But this is just to lay out the data for you to then be able to make better decisions for yourself to alleviate this pain and get away from it. So the big things that I want to talk about here, some of this we have data on in terms of actual hard numbers, and some of these we do not. But these corporate investments, corporate commitments, right, are going to be mostly spread across manufacturing, pharmaceuticals, chips and AI, automotive, and logistics. These are our top 5 industries in the upcoming initiative, which aligns a lot with what we've already been seeing across this year and what I just said, the response to the tariffs. When you're talking about India, Vietnam, Thailand, and Southeast Asia, what did I say there? It's gonna be tech, semiconductor, and overall manufacturing, right? Right, like clothing is considered manufacturing. What we just saw this past month, right, between healthcare, pharmaceuticals, logistics, one of the ones, and manufacturing as well. So these are the industries that you need to continue to look at. Okay. This is what's not only growing right now month over month. This is not only the industries that are going to be currently impacted of the active negotiations of tariffs, but these are also the ones being affected by the commitments. So please hone in on these industries in order to give yourself the best position moving forward. Okay, so what are we actually looking at here? So the UAE, United Arab Emirates. So this is not necessarily a company, but a country. So they have committed to investing 1.4 trillion over the next 4 or 5 years. So they are by far the single largest, single largest investor that is committed. And they are looking at investing into AI, semiconductor, energy, and manufacturing. Again, we have 3 out of 4 that we've already been mentioning as kind of our big 5: AI, semiconductor, and manufacturing. Now, one of the things that is also understated that we really need to understand is, where are these companies investing? The US is a big country, right? What if they're investing in Texas and you live in Illinois? This doesn't help you. So again, because this is sort of a future outlook in where these companies are investing and what they're investing in, I want to set you up to both know what skills to develop, where to reskill, but also, can you set yourself up for a successful and financially savvy relocation? Okay. So where are these? So we're looking at the UAE, who's going to do about 1.4 trillion in AI, semiconductor, energy, and manufacturing, and they are primarily looking at investing in Texas and Louisiana. I have no idea about Louisiana, as to why that is, where they're looking at. So I found that one is very, very interesting. They haven't really announced the details, but I'm imagining it probably is similar to Texas. It has something to do with the tax side of the equation. But they are looking at doing tens, if not a couple 100,000 jobs with this 1.4 trillion. Especially when you look at the fact that you have other companies who, it seems to be pretty consistent job numbers, that they're getting about 50,000 jobs for about a $500 million. Right. So if you were to translate that into the 1.4 trillion, then you would be talking about 140,000 jobs or so. So there's going to be significant job creation if this investment goes through in Texas and Louisiana, again, across AI, semiconductor, energy, and manufacturing. Saudi Arabia, again, another country. This is our last country. The rest of them are going to be companies. So they have committed to doing 600 billion across energy, manufacturing, and tech. And they're looking to do about 50,000 energy jobs in Texas and Oklahoma. So again, we're looking at continued growth for Texas. So here's another thing, right? If you're looking for investments, Texas might be a great place to invest. It's already got a high entry point to invest from a real estate or infrastructure perspective because of the growth from people departing states like California and New York. I believe Texas, it was Texas, Florida, and Nevada were the top 3 influx states over the last few years. From a population perspective, it's looking like Texas is just going to continue to grow, especially from the energy perspective with their low taxes and their energy independence from the rest of the U.S. And so the Saudi Arabia is looking to do about 50,000 jobs for their 600 billion, again, across energy, manufacturing, and tech in Texas and Oklahoma. Apple is doing a new $500 billion investment for a whole new factory. Where? Again, in Texas, which is going to be about 20,000 jobs created there. So we are talking somewhere in the neighborhood of about 200,000 jobs created between the UAE, Saudi Arabia, and Apple, just in Texas alone, across AI, semiconductor, energy, and manufacturing and technology. Again, it's our big 5. The only one that I wasn't in our original was energy. And so instead it was healthcare. But again, like these are the top industries consistently across the board when you look at the companies and what they're investing in. And again, this is over the next 4 or 5 years. So this isn't going to be tomorrow. But if you are somebody who's maybe looking to move, looking for lower taxes, realizing that, hey, AI or technology or whatever, my industry and my career is being replaced and displaced, where do I need to go? You're asking these questions. Potentially relocate to Texas, Oklahoma, or Louisiana and go into the AI, semiconductor, and energy side of the equation. We also have NVIDIA, who's investing $100 billion in AI and semiconductor. You have SoftBank, OpenAI, and Oracle, Project Stargate, I think is what it's called, who's committed to $100 billion in AI infrastructure and data centers. Taiwan's semiconductor industry has set $100 billion over the next few years, so around 3 years. They are actually choosing to not do chip manufacturing in Texas. They are actually looking at going into Arizona. They have announced 3 new chip plants in Arizona, and this would be huge, especially because Taiwan is also one of the countries that's coming to the table for negotiations around the tariff side of the equation. So if we can do free trade and they do job creation and investment here in America, this could just be a win-win-win across the board. You got Johnson & Johnson has committed to a $55 billion investment over 4 years in plants and manufacturing in North Carolina. You have Eli Lilly, who is going to do 4 new drug manufacturing sites. I don't think they've said where. So again, we're talking manufacturing, but about $27 billion. Now, some of the ones that are a little bit more vague, we don't quite have all the details we'd like. So Hyundai has said that they're going to do some investment in the U.S. Honda said the same thing, that they are actually going to be moving their manufacturing plants from Mexico to Indiana. So that could be a place that, again, we're talking manufacturing and automotive, that we're looking for expansion. Stellantis, Volkswagen, and Volvo. I mentioned Germany earlier. Volkswagen is already realizing that Mercedes has a huge advantage, but these 3 big car companies are going to be doing some additional U.S. production. They haven't announced where and how much. So that's going to be an automotive expansion. An electronics manufacturer, Compal and Inventec, has said that they are in the initial exploration stage. So again, we kind of have to wait and see. Campari and Essity are also considering to ramp up U.S. production. Merck, which is pharmaceutical, and GE Aerospace, which is obviously aerospace manufacturing and technology, they have also announced investments. So when you look at the total amount of money here, that effectively it seems to be pretty consistent, that somewhere around 500 billion, give or take, gets you about 50,000 jobs. So if you take that right now to that 4.6 trillion, that puts you at about 450,000 jobs created over the next 4 or 5 years across these companies. And what do they all have in common? The industries. It's going to be AI, semiconductor, energy, manufacturing, healthcare. End of story, right? Then there's some automotive as well. And so automotive, which I think would be good because I think that it's not going to happen overnight, but this is going to allow the displaced automotive workers that are happening right now to be reemployed into those future plants as well. So again, none of this could happen. Please take all this with an asterisk for these committed investments. But this is also 60 days into a lot of the changes and announcements and a week after the tariff announcements. So we could have a much better scenario, or much better insights, I should say, coming at a Q2 evaluation of 2025, which I will absolutely do when we get through Q2. So again, if you are looking at industries, locations, etc., key industries to look at if you are looking to upskill or reskill: AI, semiconductor, energy, manufacturing, healthcare. If you're looking at places to relocate where jobs are going to be created: Texas, Louisiana, Oklahoma, North Carolina, Arizona, Indiana. And it's across, and we're looking at somewhere, like I said, around 450,000, 500,000 job creation if you just extract a linear dollar to job creation scenario. And this should hopefully only continue to grow. So what are my overall predictions / recommendations? I think that there's going to continue to remain a lot of consumer hesitation or sentiment loss. I think that until the trade negotiations are through, that it's not going to go well. But I think that the fact that right now we have negotiations between India, Vietnam, Thailand, Southeast Asia, and Japan and EU going on, or EU trying to figure out their stuff, and the UK. I think as we start to get finalized negotiations, I think consumer sentiment will rise, which is good. The reason consumer sentiment is important and is tied to job creation in an indirect way is because that affects the stock market. When the stock market goes up, companies have more money to invest because they have higher valuations. And so this just leads to greater and greater investment as the stock market rises. Again, we also have the commitment, right? So if you're looking at industries to target AI, semiconductor, energy manufacturing, healthcare. If you are looking at specific positions to go for, right? I am going to say that you need to target technology, AI, really technology related roles. As much as they're being displaced here and there, I do think that they're going to win in the long run. So you need to learn specifically AI and manufacturing skills. And this might mean you start over. It might mean that you have to go back to school or take certifications or these sorts of things. Right now, the roles that are in flux heavily. And so if you are in this, I'm not going to tell you to drop it because I still think they win in the long run. But I think you need to develop in skills in order to increase your mastery while you're looking for jobs, which are going to be software engineer and developers and data analysts and engineers. Sorry to say, I think the administrative roles that are lost, that are being displaced by I don't think they're coming back. I'm sorry. I don't think that that's going to be the way to go. So I think that what you need to do is I think job growth is going to continue to occur. Like I said, private sector's net 30,000 jobs positive this year. It's the government layoffs that make us in a net negative. Month over month, private sector has increased job creation by 50%, which is massive. We're looking at a lot of foreign investment that's going to be coming in. We have wage growth year over year that's outpacing inflation year over year. So that's huge. So I think it's a slow and steady wins the race. I think if you are in the job market, continue searching. But if you are in administrative roles, if you are in product management roles, if you are in the tech industry, or if you are in the retail industry, consumer product industry, I think you're going to continue to see declines there, and you need to pivot to automotive, tech, logistics, healthcare, AI, semiconductor. I think these are going to be the industries that boom like nothing else. Automotive is going to be a little bit of a lag time. Same thing with tech. So I think that these are going to take, I'm going to estimate about 6 months or so to recover, maybe 3 months. I think it's going to take a little bit for those to recover because you're going to need the time for the investment and manufacturing facilities and things to take effect, as well as you need some of these trade negotiations to finish and get finalized. So I think we're looking at about 3 to 6 months for tech and automotive. So I hope all this helps you to position yourself for a successful job hunt, not only now, but also sets you up for a successful career and understanding and reading through all these headlines, because you're going to have headlines that are like, yay, Trump's economy is the best. And, oh, this is terrible. Ignore the headlines. Just look at the data and interpret yourself. So I hope that this data helps you understand where we are truly at. And so I appreciate you joining me today. If you have any comments, if you have any questions, need any clarification on things, leave a comment down below. I will respond to every single comment every single time. Check the track record. If you even have feedback on my content, you want to see me produce something that I haven't or cover a topic that I haven't, leave that down below as well. This is meant for you and to be valuable for you. And so all that feedback is very, very welcomed. Don't forget to sign up for our weekly webinar every single Friday, link down below. Hit me up on Connect if you need a quick one-on-one, which is also linked down below. And if you're looking for some one-on-one coaching, start with the quiz link down below and book a free consultation. I am also posting content on LinkedIn, my website, blogs, X, Facebook, and Instagram. So check us out there. And until next time, thank you for joining me.